Swayam Prabha. Digital India. Educated India.
Hello and welcome to this lecture 3 of the series that is talking about ESG analytics and green finance. My name is Atul Tripathi and I'm honorary adjunct fellow at National Maritime Foundation. So in today's lecture, we'll primarily talk about the weather risk and the volatility that is happening on the impact regarding the financial markets, what kind of climate volatility we are looking at, what are the various financial products we're looking at, catastrophic modeling bonds that are there. What about the parametric insurance factors that you need to take into consideration? How do you measure it? We'll also look at some of the interesting platforms that are available on the web and across the world, the way this is being monitored and this is being monetized in the terms of data and the use of technology around it. So that's going to be the focus of the discussion today. So having said that, let's start off with the first thing. First thing first, what is weather risk and the impact on the volatility factors you're looking at? I mean, if you look at it completely, the first thing that is happening is from the farm fires to financial markets. That's where the problem has started off, and it's affecting the core financial determinant, and it's shaping the revenues, creditworthiness, and investment stabilities. Something that we have discussed last time around. And that's when we look at it, in terms of agriculture, it's a highly dependent, weather-dependent product, It depends on droughts, the floods, the pests, the insects, and all kind of stuff we're looking at. And therefore, it's having a crop, severe yield volatility is there. The impact, if you look at it, it is in terms of your credit defaults for the insurance payments and payouts and supply chain food shocks that are there, food inflation. So if you look at it, agriculture has been the most uninsured sector about, say, it's expected about greater than about 25%. That's the disaster losses you're looking at. That's a huge number, 25%. I would repeat myself, that's a large number of losses. It's also having an impact on the energy market, particularly energy generation, whether in terms of hydro or solar or wind, anything else around that, and the consumption patterns, the change that we are seeing in today's world, and as the climate is changing, there's the kind of energy consumption patterns that are changing around. The renewables are facing both the upside and the downside risks, particularly in the case of storms that are happening in case of when you have these windmills that have been established on the oceans and ocean beds and ocean sides, and they have impact on there, the impact on the solar energy, all the other renewables, they're also starting to face the impact. Then the infrastructure is obviously one of the candidates for that is there on a severe factor as far as the climatic change is concerned, particularly in terms of hurricanes, floods, typhoons that are occurring, the impact on the corrosion of the materials that are there, how is it impacting on the infrastructure, destruction of the infrastructure, then rising in maintenance and retrofitting that is required because of the climatic changes, and the banking and the financial services that we've talked about, and the stress testing that we talked about in the last lecture about ECB and BOE mandatory requirements. And if you look at some of the other things, like soup, 10% of influence is happening, 10% sales are influenced by the weather in February and South Central regions. That is what is happening in the US. And look at the heaters, 16% sales are influenced by the weather in October in the northeast of US. So that's a large set of numbers, and that's where the problem has started to emanate completely. When you look at the factors such as your volatility or the climate as a factor, since 2017, $1.3 trillion in economic losses. That is as per Swiss Re. And why is it happening? It has been attributed to extreme weather events that has been happening globally. You look at agriculture, you look at infrastructure, banking. We talked about it, So look at agriculture, the impact and the yield loss, to the credit stress, to the insurance payments, the infrastructure, you're looking at physical damages, to assess and impairments. And then look, Jakarta had a real estate devaluation because of this factor. The crop losses NPs in India surging because of the impact of change on the climate volatility. And when you look at it, according to Swiss Re, the climate-related losses have topped about $140 billion in 2023. That's nearly about double the average in the past decade itself. And WMO reports states that the climate-related disasters have increased five-fold over the last 50 years. That's a large number you're looking at. These losses have been unreported in financial auditing, and therefore it is having a severe impact on the financial markets itself. Regulators are responding to it in various ways, such as ECB, BOE, and RBI are conducting climate stress tests to evaluate financial sector exposure, which is something we discussed about it. Then we talked about the TCFD, IASB, and then GFS. Then we talked about the climate value at risk, something which was a very important topic in the days. Now, look at the way the physical risks have increased 70%, and the chronic GDP impact that is having it about 30%. And look at the current adaptability capacity. When you look at across the countries like Japan to Australia to Hong Kong to Thailand, India, Indonesia, all of them are facing these expected losses, and the manner in which this needs to be handled in terms of financial systems altogether. That also brings me to another factor, that is ensuring. How do you ensure against the inevitability? The climate change is an inevitable factor, and it's not going to be there. You cannot change it. So, as I said, $143 billion insured losses in 2023. Yet, most weather-exposed sectors remain under or uninsured. That is as per Swiss Re 2024 reports. Now, when you look at renewables, the wind variability to wind average speed coverage is resulting in revenue assurance for the turbines, And microfinance is having another area. Credit defaults are happening very high, and that's where the weather-linked insurance, credit insurance markets are having an impact and resulting in lower NPA for the lenders itself. Why are they gaining momentum? Because essentially climate volatility, is making weather patterns go all the way haywire, and it's becoming the patterns are becoming less predictable and more destructive, especially for sectors like, as we talked about, energy, agriculture, microfinance, banking, real estate, all of them across the board. In India, take the case of India, Pradhan Mantri Fasal Bima Yojana integrates about whether it is started to integrate the weather data into for the crop insurance altogether. And then you have in Africa, you have startups like Pula, P-U-L-A. Pula, P-U-L-A, that's the startup there in Africa. And then they're talking about an OKO, O-K-O. These are they're talking about delivering parametric insurance to millions of smallholders, farmers via using mobile applications and mobile platforms. Then you have Lloyd's, London, and Swiss Re that are scaling up the parametric weather products for infrastructure and ESG portfolios. So now, if you look at it compared to a normal indemnity-based insurance, a parametric-based insurance, it just talks about all the way starts from the catastrophic event modeling to third party, which is in verifying your intensity, and the payment is issued as little as 30 days, which is a confirmation coming under losses within the 1 year time period. Compare that with the normal indemnity-based insurance. You look at assured assessment damage, then you have submission of the claims, and then renewals, and they are being renewed all the time. Then the adjustments are happening, and finally the claim is being paid. So this is a very, very fundamental difference between the way the parametric assurance and insurance is happening versus the indemnity-based insurance. That brings me to another point about how do we handle this parametric insurance when the climate itself is triggering it out, So parametric insurance is translating your weather volatility into a financial product for sectors with high climate exposures. So it's just not an option, it's a necessary now. If you look at a traditional policy and you look at a parametric policy, the main trigger is the damage or the loss estimate in case of a traditional policy versus parametric policy. We talk about event-based occurrence, and the climate and the processing can be complex, it can be adjusted and can take time in case of a traditional policy that is happening, while in case of a parametric policy, if you look at it, it's transparent, based on parameters or indices that have been agreed upon, and there's a quick settlement. And then you have the structures, when you look at it, the standard for products and contracts, wordings, and some of the customization that is taking place. This is a case of a traditional policy. However, in case of a parametric systems or a parametric policy, it is customized product with highly flexible products that are there. So insurance outcome and contracts are derivatives are there in the form, and while in case of traditional policy, it's an insurance contract only. So how does it actually work? So basically, a parametric assurance is based on independent parameter or index that is correlated to client's losses. Very, very important point, such as temperature, wave, height, wind speed, it can be multiple other factors. Once the threshold is reached, the payment is triggered automatically. This is where it becomes very interesting. So say if you have a wind speed and it has been agreed 10% below 5-year average, payment triggered automatically. And this product is offering a seamless customer experience, optimizing the insurance processes and amplifying the scope of insuranceness. Now look at some of the triggers we're looking at. Rainfall. A case of let's take 40 mm less than in 10 days. Immediate application areas can be agriculture and hydro energy sectors, which is going to be where the triggering of the payment is going to take place. Wind speed. Anything that is greater than 110 kmph, sustained gusts, the property and cargo damages are immediately assessed and parametric insurance begins to float in. So that is where the speed, the transparency, the affordability, the scalability is this what the biggest achievements or biggest, I would say, definitions or the benefits are. So take the case of, if you take the case of India, Pradhan Mantri Fasal Bima Yojana, which has, as I said, a few minutes back, it has incorporated weather-based crop insurance, where the government is backing the parametric product using rainfall indices for the farmer compensation. In Kenya, you have Pula and ACRA Africa, where micro-parametric crop insurance has been scaled up via mobile platforms, which is reaching about more than a million farmers. Caribbean has using CCRIF SPC, which is talking about regional catastrophic insurance pool using parametric triggers to provide post-hurricane liquidity to 14 plus countries. And in Philippines, they have AXA Climate is another parametric typhoon protection for small businesses and schools. So it has got down to that levels where schools, businesses and everything else is being covered completely. Now, in the similar lines, if you look at it, there comes another thing that is called as crop yield index insurance, which is about protecting the farmers and stabilizing economies. When yields fall short, so do livelihoods. Very important point. Crop yield insurance, transforming the harvest losses into a predictable payout. In countries like India, particularly, yield indexed crop insurance is covering about 25 million farmers, which is protecting the livelihoods because of the climate volatility we're looking at. So what exactly is this crop yield insurance? It's about the risk transfer mechanism where the payout is based on area level average yield, and it's not an individual farm losses you're looking at. So the farmers receive compensation when the average yield for the area is falling below a predefined threshold limit. For example, say 70% of the normal historical norm, anything that it'll trigger off immediately as a predefined threshold level. Then, if you look at the unit area, it can be a block, it can be a district, it can be an agroecological zone as per defined and agreed. Trigger yields can be as thing as threshold percentages and defined by the 5 to 7 years of historical yields. Payouts is linear in nature, and while the yield estimation is depending upon the crop cutting experiments and the patterns that are there and the remote sensing methodology that is used. There have been some studies that have happened in this regard, and that's where in India, this is again coming out with Pradhan Mantri Fasal Bima Yojana, which is world's largest crop insurance program using yield index at village and block level. Then you have in the Mexico Cadena program, which is covering small farmers in drought prone regions using at municipality level, which is resulting in the yield. Then you have in China, there is a Heilongjiang province, they have got extensive yield insurance, index insurance on soybeans and maize, which has been backed by remote sensing and subsidies. Actually, what happens is that it is reducing your moral hazard because the farmers cannot manipulate area yield. Nobody can do that now because it's been agreed between all the parties concerned. And it's scalable because at administrative levels, you can look at large regions. You can minimize your losses which is immediately being verified. Then you have affordability because there is a government support or the subsidies that are being made accessible to the farmers holders and all the stakeholders. Then there's a food security that is there because it is ensuring that the farmers are income is continuity is being made. So essentially crop yield insurance is just not about the payouts, it's about predictability, it's about resilience, and it's about safeguarding the supply chain shocks that might be experienced because of the variability in climate and natural disasters, and the farmers becoming more safer in their approach towards the farming as a whole. Another thing that we need to look at is the cyclonic, parametric insurance and the protection from the coastal economies. That is very important because the tropical cyclones have caused about $275 billion losses in economic, in terms, particularly in the last 5 global years, as per Munich Re NatCat 2023 report. Because when cyclones hit, there is going to be delays in claims cost, because that there's going to be a lot of damage. And the parametric insurance is the one that is going to turn the weeks of assessments into an instant recovery part. And, there is going to be a lot of sectors that are going to be impacted in terms of the entities as well, like ports, to telecoms, to wind, to refineries, to state distilleries. And the value of the parametric coverage, again, depending upon the various factors that one needs to look at. So why the cyclonic risk is a parametric financial threat? Because cyclones are no longer a rare act of God, as they call it, quote unquote. They are increasing in intensity and the frequency due to warmer sea surface temperatures. And for the coastal global economies, these cyclonic triggers are the ones that is simultaneously assessment damages are being caused and the businesses are being interrupted, and there's a complete breakdown in the supply chain. Therefore, it is creating a systemic loss and not an isolated event, because the traditional indemnity insurance is the one that is requiring your loss assessment, and therefore it is delaying your liquidity when it is actually needed the most. And then, the parametric insurance is the one that is going to solve your conversion of time to assessment to an instant cash liquidity factor. It's also important to understand how this actually works, because you see, when you have a defined trigger, say a wind speed which is greater than 120 kmph within a 50 kilometer radius, that can be one of the defined trigger, And the data sources are going to be taken into consideration. So you have the IMD cyclone bulletin that is going to be taken, or NOAA data, or ECMWF models that are there. That are generally taken as the data sources, and then the payouts are determined, or payout scale is going to be determined. So you see, higher wind severity means higher payout, as per pre-agreed payout curve. And again, the settlement time, because you are looking at movement from weeks to days, it's generally about 7 to 14 days, and this is making the payment very objective and transparent, and ensuring that there's no disputes around this in payment, because the speed is a reliable trigger. That is what is being assumed, because wind speeds are precisely monitored by satellites, buoys, the Doppler radars, cyclone reconnaissance models. So the multiple ways they're doing it, and they are strongly correlating with the physical damage that can be caused to power lines, to port cranes, to turbines, to refinery units, warehouse roofs. And this is where it's going to provide the insurer and the actuarial models a clarity, in terms of the predictability of the recovery of the finance. And therefore, the integration with ESG and TCFD and climate reporting is becoming another important issue, because parametric insurance model is going to improve your capital resilience metrics under TCFD finance, physical climate disclosure, or ISSB, IFRS S2, where you're looking at climate resilience stress testing. You're able to provide your auditable model-based risk quantifications. That is why parametric insurance is increasingly being integrated into the ESG-linked loans, the sustainability-linked bonds. And then when we look at how you're going to design your payout curve, conceptually, you look at the trigger point, so wind speeds, where the loss begins, and to the inflection point where the operational shutdown is going to occur. And then the maximum payout point, catastrophe threshold risk that you're looking at, say anything that's greater than 160 kmph. So if you have a, say, typical payout curve can be like, for a wind farm can be like, okay, if I have a speed of 120 to 140 kmph, then I'm going to have a 40% of the payout, and then 140 to 160 kmph, then about 70% of the payout. And if I've got anything greater than 160 kmph, then it's going to be 100% payout. And this is where it is aligning to the financial compensation with regard to the damaging of the increasing your damage probability. And therefore, this is another important point that needs to be considered, is the flood index depth. Because over 1.747 billion people globally are being exposed to flood risk, with about $5 trillion in assets which are vulnerable by 2050. This is as per Swiss Re, global catastrophe risk. And when you look at it, the flood risk depth insurance is the one that is, again, it's a parametric insurance model, again, where the product payouts are going to be triggered when the water depth is going to cross a certain predefined level rather than, requiring a damage inspection, because it is using a very objective and a third-party flood data like your remote sensing, your river gauge telemetry, or IoT sensors, and it's very transformative in nature, because in case of a traditional insurance model, the flood depth insurance index is used, and there's a lot of month-long claims because and here in the case it's going to be an instantaneous payout. In the case of a traditional insurance, you're looking at a higher administrative cost versus a low operating cost across the board, and exactly again in the similar manner, like any other parametric insurance product, it's going to be having a trigger factor. So say if water depth is greater than 0.7 for 6 hours and it's being covered in about 40% of the zone, then there's going to be a payout. And then the water depth is greater than 1.5 meters, then there's going to be 100% payout. So you can use a lot of data sources. So some of them, this model has been built on some of the data sources, like you can have in situ sensors where you're looking at gauge stations and the municipal flood gauges, and then you have the remote sensing where you're looking at Sentinel-1 SAR radar and MODIS and Landsat. And then the application uses cases are multiple and across the board, because you're looking at agriculture to urban MSMEs, and then the state disaster relief funds where you're looking at reduction in the fiscal shocks and the speeds and the emergency cash distribution, your housing and the infrastructure programs, and when you look at the design considerations. So if you look at this point, this is about the economics of the development, the damage that are being caused, the physical damage that is being caused because of the floods, So when you look at it in terms of design consideration, you look at the zonal mapping to calibration with the historical depth of the impact curves to the tiered-based payout structure, and then there have been multiple cases that have been utilized and have been very successful in nature, like your Kenya Flood Index Insurance Program, where you have looked at IoT river gauge network triggering community-based payouts, to Bangladesh Flood Watch Program, where the payout has been delivered via even the mobile money during the monsoon peaks. And even in India, we have had cases of in Assam and Bihar as a pilot programs where Sentinel-1 SAR was used to define the real-time flood severity grids, and that became a very popular one. And another one is particularly in the case of India, if I was to look at it, is from the perspective of solar isolation index, where you're looking at solar power, because solar power projects are facing up to a 12 to 18% annual revenue volatility, primarily due to isolation variability, and this is as per IEA Renewable Energy Market Update 2024. What exactly is the product covering? It's covering around the triggering, payouts when the solar radiance is coming in terms of kilowatt hours per square meter per day, failing below an agreed threshold level, and therefore it has been designed very specifically with the solar project developers and the asset owners and the financiers to stabilize the cash flows, because the isolation risk is what is mattering the most. When you're looking at reduction in sunlight, it's lowering your plant load factor, which is called a PLF, and once the PLF drops, then the lower energy revenues are being recorded, and lower revenues means it's becoming very difficult in servicing the debt and meeting the IRR expectations. Therefore, isolation fluctuations are climate driven and very unpredictable in nature, making the conventional risk transfer completely insufficient in nature. And when you look at it, the trigger factors, again, you're looking at the satellite-based solar irradiance monitoring. So take a case of NASA Power or Copernicus CAMS, or even Solargus real-time data that is being taken into consideration. And when, again, in the terms of the trigger models, the expectation is that 5.18 kilo megawatt hour per square meter per day is what you're looking at. So any isolation that is dropping below 5 for greater than 10 days, greater than or equal to 10 days per month, then the payout is going to be immediately released, because this is again going to be a percentage based. But the best part is that there's no site inspection, no claims paperwork, and no disputes on damage, because it's being monitored in the real-time data. So very classic case of use of data and real-time artificial intelligence and GIS. This is resulting in some key benefits like your revenue stabilization, because you're smoothly making a PPA cash flow, ratios, and then bankability enhancements because you're improving your debt service coverage ratios, DSCR confidence levels. Then you have the risk transfer because you're moving away from climate variability of project balance sheet to investor confidence because you're enabling your institutional investor grade risk management. And currently, when you look at it across the world, it's being used very popularly in Chile, where the desert solar farms are hedging the isolation variability to secure project financing. In India, Rajasthan and Gujarat developers are piloting irradiance index covers for utility scale solars. And the European Union, you have the corporate PPA solar buyers, which are using your isolation index to hedge your profit and loss volatility, because they have already taken certain design considerations such as spatial resolution mattering, where you're looking at a better grid means equal to fewer basis risk disputes, higher historical solar data calibration is resulting in your minimum number of 15 to 20 years recommended. Your tiered payout design is avoiding your full payout on minor fluctuations. So solar isolation index is the one that is turning your renewable variability into magnifiable financial variable, and this is strengthening your clean energy investment and confidence level and in energy transition stability. On the similar lines, when you look at it again, what happens if the case of risk, in terms of weather variability, because the probability is the one that is mattering in case of your climate risk. The probability is converting your weather uncertainty into measurable risk, So if you look at this diagram, it clearly states that because insurers, reinsurers, banks, they're using the probabilities to price your parametric insurance, estimate the loss damages, and determine your resilience investment priorities. Because again, data sources are being used, multiple of them, for probability modeling. So you have the historical records, which is coming from your rainfall to cyclone tracks to wind speeds to river discharge levels, and then you have satellite-derived geospatial climate data sets. You have real analysis models such as ERA5 or MERRA2 for continuous climate data way back in the 1950s, because when you look at the data types, the rainfall history is coming from IMD and CHIRPS, which is actually talking about the flood and the crop insurance modeling. Then you have the cyclone intensity, tracking, which is coming from JTWC to IMD cyclones. Therefore, the probability estimation techniques that is being used is the frequency analysis, how often an event is going to occur historically, which is going to be 1 in 20 years flood, or where it's going to be equal to 5% of probability. Your return period calculation, there you're looking at probability is defining as 1 divided by the return period. You have the Bayesian updation that is taking place with adjustment to the probabilities with the new climate signals, and the climate and the challenges, the considerations that one is taking is the climate change breaks in terms of historical stability. So you have the trends which have been accounted for. You have the local station gaps in terms of the station satellite data, which is being interpolated with the help of machine learning approaches, and the compound effects which are requiring your multiple variable modeling. So the historically climate data is allowing you to quantify the likelihood of future weather extremes and enabling the scientific pricing of the climate risk and inform this investments in terms of the resilience. And on the similar lines, you have the measuring severity, which you're talking about. Severity is being measured and how much an observed weather variable is there in terms of the rainfall, temperature, speed, and how much is deviating from your long-term historical, the averages that is there. Because in terms of the mathematical terms, it's often expressed as the magnitude of deviation from the mean or the Z-score, something that we see out here. So there's a shift on the right-hand side, because of this thing. And so your normal rainfall is, say, for 30 years is about 100 per month, whereas an actual rainfall is 250 per month. So your mean has now shifted off, and therefore the deviation of 150 is taken as a severe flood condition. And why does the severity matter? Because it's going to determine your loss magnitude, and it's going to differentiate between a minor flood versus a catastrophic inundation, to a warm spell versus a life-threatening heat wave, and therefore now severity is the intensity lens of the climate analytics. It is transforming the weather anomalies into quantifiable financial risk, enabling pricing, proactive adaptation, and the resilient investment decisions. And when you look at cat bonds is another one that comes around. CAT bonds have become, or catastrophic bonds as we call them, they are in 20, they are, I would say they're the insurance-linked securities that are allowing the governments or insurers to transform extreme weather risks to investors, and they're being triggered by a predefined set of disasters that have been, again, the threshold that have been defined, such as earthquakes, monsoons, typhoons, hurricanes, wind speeds, cyclones, everything has been predefined, flood level depth, how much is it? So you predefine it, and then that catastrophe bond triggers in. So when in 2023, about $15 billion in catastrophe bonds were issued globally, which is about 37% up from 2024. This is as per Artemis Deal Directory 2024. And the governments and reinsurers are seeking climate resilience because hurricanes, as they are intensifying, floods are growing costlier, financial new heroes are emerging, such as in terms of catastrophe bonds, because in the insurer is there, he's looking at the sovereignty of the entities, he's looking at the reinsurers, world banks, and the SVPs, special purpose vehicles, the trigger types that have been predefined. The term is it's typically between 3 to 5 years, and the coupon bond is about 6 to 15% due to high risk, and the payout is in terms of rapid disaster response rebuilding, And what is the kind of trigger you're looking at? So if in case of payout trigger, the actual losses are happening because estimation is being done on the total indemnity, and you have the losses that have been experienced by the insurance industry in the region, and therefore resulting in value of the physical indices related to event, such as wind speed in millimeters or rainfall, earthquake, magnitude that is happening. So if you look at the entire flow out here, so you have a natural disaster which is happening, which may take place, unfortunately. You have the risk modeling agents that are estimating your expected losses estimations, and immediately once the risk modeling agents are also they're triggering out the catastrophe bond because there's a disaster that is resulting in. And then your payment is happening because there is an SVP, special purpose vehicle, which is you're paying a premium plus the principal from the investor to and that is where the trust is coming into picture, because the principal and the return to the collateral is taking place. This is the complete flow of the catastrophe bond that is happening. Let's take a case study in this regard, and that's the African risk capacity drought insurance that saves lives before actually the famine strikes. In 2022, ARC disbursed about $10.7 million to Malawi and Mauritania within 30 days of drought triggers, protecting over 1.5 million people from hunger. This is as per African Risk Capacity and Annual Report 2023. These derivatives are becoming very important because of the fact that you're looking at in terms of various things like ESG derivatives, or your, say take the case of this very popular platform that is there. So you have the Africa Risk View, where you're looking at the satellite-based drought modeling platform, which is combining your rainfall data with the crop models. Then you have the parametric trigger view, where your payout is being linked to the deviation from the expected rainfall payout and estimated yields. And the premium funding, where some countries are using, such as donor countries such as UK, World Bank, they are using to subsidize your premiums. And that's where a very popular platform of this thing comes from, tce.arc.int comes around. And when we go to this website, we see there's something very interesting. We can clearly see what's happening in the real time with respect to your tropical cyclone that is happening. So we can clearly see what's happening. So you can see over a time period, say starting from Monday to all about the current date, that is, the time when this lecture was being recorded, about 8th of September as in present date. So till about 7th of September, where you can clearly see the movement of the tropical cyclones, because they are going to be having a very severe impact of drought on this area. And therefore, another important point that we need to take into consideration is this case of your weather risk market. So what exactly are weather risk markets? They are essentially financial markets which are allowing you for pricing, trading, and transferring of all weather related risk. So unlike your traditional insurance, where weather risk markets focus only, here the weather risk markets are focusing on measurable weather events rather than just on the proven losses altogether. They use various kind of parametric triggers. So, weather derivatives, such as, crop yield hedging and revenue tourism is one area that can be used, and then the temperature and the rainfall can be the trigger around it. So for cat bonds, it can be used for your transferring of the risk of the hurricanes, wildfires, and the event magnitude. Similarly, for weather swaps and options, temperature days and down snowfalls can be one of the kind of a trigger, because in 2022 over $22 billion in weather risk related insurance, weather risk related instruments were traded globally, and they were essentially driven by climate volatility and insurance gaps. Now that's a big thing you're looking at, because the key players in this group are your CME group, which is actually offering you weather futures and options on the US and the European cities. Then you have the Swiss Re and the Munich Re, which are again your major reinsurers, which is where they're designing your parametric weather insurance products. And you have the World Bank Global Index Facility, another one GIIF, which facilitates actually the weather index insurance in developing economies. And you have the hedge funds and the energy traders, again the very high use of this kind of information, where they are using weather to hedge against the seasonal risk in portfolio, because there are multiple economic relevance that we see. One of them is agriculture, because insurance based on rainfall or temperature indexes are very popular. Similarly, in case of energy, the power demand, which is being hedged against heating and cooling degree days, something we'll just talk in coming few minutes. Then you have the infrastructure and events that are very important players, because the insurance for construction delays and the outdoor events that are there. Similarly, for banking, you have the loan default risk pricing for climate vulnerable regions. Again, a very important factor that needs to be taken into consideration as far as the economic relevance is concerned. So the main thing is that weather risk markets, they're transforming your uncertainty into a tradable instruments, which is empowering your sectors to hedge, the governments to respond, and the investors to diversify against climate volatility. Because take the case of a real-time weather data where it is collecting from country X, say with the National Meteorological Services, and then this data is being verified and validated on an ongoing basis. And similarly, when the country X is designing a particular maize index, which is where it is linking your rainfall and the maize production, so that if the precipitation falls below a certain level, the index will then begin to reflect the projected losses in maize production, and therefore the level of rainfall is only variable in the index. And then similarly, you have another thing called as, take the case of a country X, and the World Bank is again agreeing on the contract as an options contract, and that is specifying the payout trigger. Say maize production is falling below a certain percentage, which is below the historical average that has been estimated by the index, and then the payout amount will take place. And the availability of the derivative of the country X is actually dependent upon the availability of the market counterparty, that is the options counterparty that is there for the World Bank. And then the country X is going to pay the premium to the World Bank, and then this entire flow of the events begin to take place. This is how the entire game plays out. And the World Bank is then going to enter, and it's going to offset the agreement between the market counterparty. And if the index hits a predetermined trigger, then the country X is going to receive a payout from the World Bank. So if the index does not hit the predetermined trigger, the contract expires on the maturity. And this is how the entire flow of events take place based on the weather risk markets that is there. Then you have another very interesting concept of that is of heating degree days. When you're looking at weather linked matrices for energy risk hedging, very important concept. When the temperature drops, energy demand surges. Heating degree days become financial thermometer for fuel, finance, and forecasting. This is very, very important. So a single HDD can derive up to residential heating cost by 10% in temperature regions. That's IEA 2023. And when you look at these products that are there, so the HDD actually talks about how climate metrics is there, which is going to quantify how much should the outside temperatures fall to a base level, which is actually generally around 18 degrees centigrade or 65 degrees Fahrenheit, signaling there's going to be now a surge in the heating demand. And this is actually calculated based on a formula which is, let me just write it down, HDD is equal to either max of 0 or base temperature, I'll call it temp in this case, minus your average daily temperature. AVG stands for average daily, DAILY, and temp is TEM, temperature is temp. So this is one. Whichever is the maximum, that's going to be one that is going to trigger off your, this kind of metric is going to be triggered off. And then the cooler it gets, the higher is the HDD. That means it is indicating that you are needing more heating energy as being required. And that's where, energy utilities and the energy and utilities company, the retails and the insurance companies begin to picture. And so you can have, for retail, it can be forecasting your weather gear sales. So HDD is being used to predict your product demands. You have utilities which is revenue stabilizing because now you have linked it to the weather derivative products out there. Let's look at another case out here, how platforms are being used. If you look at this, so now if you look out here, we are looking at US's current wildfires. So it is indicating on the map where the wildfires are taking place and where your HDD is going to trigger off the product. And you can enlarge this thing, you can play up with the platforms. As we talked about a few minutes ago, the use of data which has been verified by a data provider. And on the similar lines, you're looking at satellite VIRIS, that is your thermal hotspots and fire activities across the world. Now you can clearly see what is happening in the world, in Africa, in places like Africa and places like South America, or even across the world, how you map your data, your use of GIS, something we've talked about, the use of AI, something we talked about in the past sessions itself. Then, if you look at another point, the thermal satellite modus or thermal hotspots, I focus specifically on India, and if you can see some of the areas around India which is going to be might be triggering off your thermal hotspots. So these are the kind of use of data plus your AI and GIS together as a platform. That's where we've started to move towards. Another thing that we're looking at is cooling degree days, which is where you're hedging against the heat-driven demand surges. For every 1 degree rise in temperature, cooling demand in urban Asia can spike by 20%, turning CDD into a bottom line metric itself. That is as per IEA Global Cooling Report 2023. Again, when you look at the hospitality and retail industry, we're looking at prediction of the seasonal sales of the cooling products to inventory planning and promotions that we need to take care of. The agribusiness, when you look at cooling link irrigation and storage costs, where you're aligning your weather indexed contracts. When you're looking at insurance industry, you're looking at parametric payout for heat stress or business interruptions, because your objective has to be a very fast payout system they're looking at. So that is, one of the big things that come around, and the CDD actually quantifies how much and how long will your average temperature exceed a base threshold level, typically again, 18 degree or 65 degree Fahrenheit. Again, when you look at the formulation, I'll just repeat it, CDD actually stands for cooling degree days, which is max of 0 or average, I will say AVG, daily temperature, TEMP stands for temperature, minus the base temperature, whichever is happening, minus the base temperature. So whichever triggers based on the maximum value. So CDD actually futures are standardizing your exchange traded contracts based on regional CDD indices that have been agreed upon. Traded platforms like CME groups, like you have it in cities like Atlanta, Tokyo, Chicago, Dallas. They're actually hedging the revenue risk and managing the budget volatility, because that might because the extreme or heat risk or events that might be caused upon. And the matrices that you're looking at, CDD versus HDD, one of the factors that comes into picture, how is the difference between them? So HDD is actually talking about heating needed winter, where main bias can be oil and gas utilities, while in CDD, your cooling need is there in this month of summer, where your main bias can be electric utilities, retail, tourism. So cooling degree days are another powerful and precision tool for heat exposure sectors, allowing companies to monetize their weather insights, their hedging financial exposures, their proof of the future, the operations that are happening in the warmer world. Now, there are again platforms that have been developed. Now, I'll take you to another platform out here. Let's look at this thing. This is the case of UK. You look at the average cooling degree days of the projection that we're looking at. This is where they have developed this kind of a platform where they're looking at average cooling days over the time period. So that gives them a clear indicator what's going to happen. Similarly, if you look at the charts and the precipitation levels, how will it change over a time period? So take the case of, you can play around with these days and you can see the changes that are happening over a time period. So take the case of, say, I want to play around with about 20, I'll just change it out to, say, 1st of September. You can play it and you can take any areas like Arctic area itself. Gives you a complete indicator. Then you can also look at some of the more prone area, precipitation area that is prone to all kind of weather related stuff. It can be, say, take the case of Southern Asia itself. Look at the changes that are happening over a time period. If I play around with this and look at 26th of July 2025, look at the changes that are happening. And if I can set up, say, about any of the 28th of July, within a 2-day time period, how did this change happen? That is another one. And look at another thing, that the monthly precipitation index. Now here we have focused specifically on the area of the Southeast Asia. You can clearly see this area, the Burma is there and the entire Southeast Asia is there. And look at, you can play around with the type, there's a timeline that has been defined. So it's all the way from January 79. You can change these timelines and you can see how it changes. It does take a bit of a time to play around with these things, but these are the kind of platforms that have been developed around in the sectors for all kind of stuff, particularly in terms of your cooling degree days or heating degree days, and your rainfall contracts that are coming around. So that also brings me to another point, is your rainfall contracts, as we were seeing in the platform, what is happening. So rainfall contracts, they're financial instruments or insurance products that are linked to payouts of recorded rainfall levels over a given time period. And they're based essentially on the weather stations or satellite-based rainfall indices, and they're using they're used to actually hedge on the production, the supply chain, the revenue risks that are excessively linked to the deficiency of rainfall. Some of the things that we just saw about here, if you can play, I'll just go take you back. How is the change in weather precipitation matrices that we saw about? Let's take a case again, within a single day, how does the change take place across the Indian subcontinent? And, in India, about 1% deviation in monsoon rainfall can impact about 0.03% of the GDP, that is as per RBI 2022 report. And then when you have the rainfall patterns that are going rogue, so do the revenues, and the rainfall output contracts are there to stabilize your rain-dependent industries such as agriculture or hydropower, constructions, even retail events, because they're offsetting your losses during the rain-affected footfall. There's a drop that has been always been measured. And the real life incidents you look at in terms of index-based insurance products are by ACRE Africa. They're paying out to small holder farmers based on recorded rainfall and soil moisture data. They have satellite-based indices that are reducing your fraud and improving the transparency. They're boosting loan access and financial resilience to over 1 million farmers, because the rainfall output contracts don't just manage weather risks, they unlock the climate risk, climate resilience, and financial innovations in rain-sensitive economies of the world, particularly in the case of India or the African nations, which are very sensitive to these kind of impacts that are there. So solar output contracts, another interesting space we're looking at is hedging against sunshine risk in the age of renewable energy. This is becoming very important, particularly in today's world of renewables, where you're looking at solar energy becoming one of the big areas. So you have the solar output contracts, which is actually a financial derivative or an indexed insurance. The payments are based primarily on solar radiance shortfall relative to the expected values. And these are actually triggered based on satellites or ground measured global horizontal irridance, called as GHI, global horizontal irridance, and they're designed for revenue stabilization in the solar energy dependent industries or operations. So basically, typically, if you look at it in terms of your low output contracts where GHI is less than baseline threshold, then you have the solar IPPs or grid buyers that are immediately triggered off. Seasonal shortfall coverage is there. Then you have GHI average, which is less than a seasonal historical average. And you have utilities or EPC contractors that become very important. Solar energy can drop up to 30% during the persistent cloud cover periods, causing revenue swings and grid instability to, as per IEA 2023. Your application areas like your utility solar scale solars, which is talking about protecting independent power producers, IPPs, solar resource underperformance, or your grid purchase agreement, power purchase agreement as they call it, PPAs. They're used by corporates to de-risk their solar supply variability. Then you have grid operators, where you're managing a renewable intermittency risks and enhancing your grid stabilities. Some of the most important players in this regard is Swiss Re Solar Performance Index contracts that have been created, where you're looking at structured deals for solar parks in the Chile and Spain. Index triggered payouts when irradiance drops below 90% of the baseline, which has been agreed upon. And your enablement as far as more favorable loan terms to renewable energy providers. So solar power contracts essentially are translating your photons into predictable cash flows, essentially empowering the transition into stable low carbon economies. Now look at some of the platforms that have been built around. Look at this case. This is a net radiation platform we're looking at by the Earth Observatory in NASA. And I'll play around this thing, a small video, and it's a kind of a very interesting thing. Now look at the change in the net radiation starting from July 2026. As you play around it, you can clearly see the changes that is happening over a time period. Now, look at the way, as the Earth rotates around the Sun, so does the change in the solar radiation if you look at it. So I'll just skip it to the current situation. Now look at March 2025 versus your March 2027. A clear change has happened over a time period. Look at this. Weather forecasting risk is another area, and where you are trying to navigate the uncertainty. And the long-term forecast may carry uncertainty, but even a 60% accuracy in terms of seasonal forecasting can reduce your agri losses by about 25%. That is as per WMO report, because when you look at the forecasting horizon itself, what is meant by that? I mean, you've been defining it by time period in terms of days. 1 to 5 days. We're looking at in terms of say utility outage preparedness, with the models are radar or NWP or satellite imagery. Then 10 to 30 days is like an ensemble method you're looking at for agriculture planting devices. And finally, your seasonal, where you're looking at trend predictions, AI based, we're looking at for index insurance pricing. And therefore, the two timelines for weather forecasting comes in terms of short term and long term. In the short term, you're looking at operational, daily planning, logistics, optimization, all that factor, And in the long term, you're looking at in terms of strategic planning for seasonal risk and insurance pricing and supply chain management. And the forecasting accuracy and the decision impact are very important factors, because in the short term, you have a higher accuracy because you're using a very binary based decision. So say whether to activate or the insurance trigger or not. In the long term, the precision is more challenging, I would say, but it is a directional valuable for the portfolio hedging and your agri insurance input planning or disaster preparedness. Primarily around sectoral influences, if you look at it, come from the energy traders, your insurers, your government bonds, and the thing is there. And therefore, choosing the right forecasting horizon is like choosing a lens appropriately, because the wider and the more zoomed in, and each will reveal different truths based on the critical nature of to manage the climate-linked financial risk. And one of the popular platforms that is used is this one, where we're looking at this CUSP by NGS. So when we go there, you can clearly see what's happening. You can look at the timelines and you can see the changes that will be occurring. Very popular tool or a platform to look at, from your national shoreline to your T-sheets that are there. So if you take, we've just taken the America into consideration, the United States to be more precise. So if we see how these changes have started to occur, let's take the case of Florida itself. When we zoom in and let's try and play around it from 1820. So when we see it in terms of the national shoreline, the impact that is happening, how the changes that are occurring to the current period, that is 2025, they have taken into consideration. A pretty interesting and an important platform to be on. And then you can also look at the various T-sheets that are there again You can expand it and you can zoom in again. We've just done it for America and the United States, to be more precise. And you have the Florida, if you take an example, and you can clearly see the changes that have occurred. So a good mapping of data that has happened to look at. Therefore, it's a very popular platform, and that brings us to another interesting point in this regard, is the use of technology. And that is where, the parametric-based approach or a satellite-driven climate-based payouts are taken into consideration, because the parametric insurance, they can reduce your claims processing time from 180 days to 10 days altogether. This is primarily happening because there is satellite-triggered automation, The various kind of indexes like NDVI and rainfall anomaly and soil moisture and temperature threshold, they are taken into consideration for various events and the application areas that they're going to be interrelated to. And therefore, you get a very complete picture with the satellite-based parametric insurance payout approach, because any satellite linked parametric insurance is very unique, because they're using derived indices such as NDVI or your soil moisture, precipitation to trigger automatic payments, thresholds when they're breached, and eliminating any of the on-site loss assessments and improving your speed, your accuracy, or most importantly, bringing in transparency to the disbursements of funds, which is a big challenge, because then it's also offering your coverage in terms of the remote and the very undeserved or unreserved regions, which is having a very deep impact on the ground. And if you look at the various deployment models across the board, so we have Africa Risk View, which is giving you an African Union perspective, which is using your rainfall and NDVI data for drought payouts in Sahel region. Then India's PMFBY, Pradhan Mantri Fasal Bima Yojana scheme, which has been running as a pilot in Karnataka, where they have used satellite-linked triggers for yield-based crop insurance. And you have the AXA Climate and Global Parametrics, which is offering your flood and cyclone-linked satellite products in Southeast Asia and Latin America. So the parametric insurance powered by satellites, it's no more about a futuristic game. It's actually where the revolution in terms of the climate resilience, your finance is happening. And it is happening at one given platform, at one given pixel at a time. That's what the precision levels we are looking at. And another approach that is becoming very popular in terms of the use of technology is the blockchain with the weather risk, where the smart contracting to smart coverage altogether, where you're able to provide your traceability. So you have various kind of platforms available, and optimization of the food chain to transactions to crop insurance. Because blockchain-enabled weather insurance cuts payout time from weeks to minutes, and it's just slashing your fraud risk, because this is as per Ethereum Climate Insurance Pilot Report 2022. So imagine when the weather risk that is triggering out automatically, paying instantly, cannot be tampered. So it's a very decentralized insurance protocol that is using your smart contracts, where you're trying to process weather-linked insurance automatically, and you have the weather oracles such as satellite data, the IoTs, your rain gauges that is feeding the data into the blockchain. And when the conditions are meeting a particular threshold level, it's again triggering out payments automatically with no intermediaries or adjusters, because the primary approach or functionalities in terms of the weather oracles, such as which is feeding your real-time weather data. You have the trigger conditions, which has been predefined threshold index limits. So say example can be anything rainfall which is less than 50 mm of rain that has happened, then that can be a predefined index for the trigger condition for a rainfall aggregate-based support systems. Smart contract, we're trying to verify and initiate payouts automatically. Public ledgers, again, bringing in transparency, immutability of records of claims and payouts, and that's where, there have been experiments that have happened across the world. So some of them are like, Etheristic plus Chainlink. They have, in Kenya, where they have looked at the parametric crop insurance for smallholder farmers, and they've linked it to the blockchain-based NDVI triggers. Then you have the Arbol platform, which is offering you a blockchain-based climate risk hedging to agribusiness and using smart contracts, where they've tied it up to NOAA data. And you have Bima Lab, in Africa again, where they're exploring your blockchain and weather in microinsurance to protect vulnerable and communities. So, blockchain, we often tend to think it's only about cryptocurrency. No, it's not. It's a trust engine where you're running faster, transparent, and more inclusive, whether in terms risk financing as a scale. That is what has become the blockchain in today's world. And that brings me to the end of this lecture series, the third part of the lecture series on ESG and green finance. And thank you for your time. That's myself, Atul Tripathi, an honorary adjunct fellow at National Maritime Foundation. Thank you.